Today we're getting two for the price of one. I was going to make a video on the state of Australian housing, Sydney, Melbourne and regional centres, which we are. Second part of this report. The first part of it is actually Chinese stock market, which had seen $1.6 trillion shaved off its peaks. It's down more than 20% since January 2018. We are in July 2018. I think it's 4th of July today. Without further ado, let's see how they've reported this and what this may mean for us here in Australia.
China's stocks back in a bear market, but will it be a rerun of the crash of 2015? And home truths on sliding prices. How nervous Sydney investors will be eyeing the exits. The bears are back in China, with mainland markets losing $1.6 trillion since January. That's a 20% slide from the peak. Fears of a global trade war coupled with extraordinarily high debt have seen the Chinese stock market hit by one of its worst months in history. And analysts say that if China hits the skids, Australia could go down too. Here's Carrington Clark.
Donald Trump continues the tough talk on trade, criticising allies and rivals alike.
The European Union is possibly as bad as China, just smaller.
Australia might not be currently in the president's sights, but it might end up being collateral damage.
We went up with the Chinese economy and we will go down with the Chinese economy.
New US tariffs on nearly $50 billion worth of Chinese goods come into effect this week. China will retaliate, and analysts are worried about what it means.
We want to beat our chest and say we haven't had a recession. We've also got an umbilical cord to the greatest, economic growth story in the history of the world. That's the start, middle and end of it.
Even before the tariffs kick in, investors have reacted. The market down another 2.5% today. The Shanghai Composite has now dropped more than 20% since its recent peak, and the normally tightly controlled Chinese currency has dropped more than 5% against the US dollar since its highest point of the year. Back in 2015, a meltdown on Chinese markets saw 30% of the value wiped off in just 3 weeks, and that sent shockwaves through global markets. But analysts say investors won't be seeing a rerun of those seismic events.
Government panicked. They move into the financial market,
Although a weaker yuan helps Chinese exports, it increases the cost of its mountain of debt.
When the US dollar strengthens, that means the company have to pay back more. Their interest payments are all in US dollars. So that just means there will be more pressure in terms of the repayment, so the company has less money to spend on other things.
Looks like China, for such a country and an economy that actually brings a lot of value, it's got productive capacity, makes all sorts of things, little $2 things and everything else that you can think of, yet they are in trouble. So they've borrowed all this, not borrowed money, but they've actually got the treasuries, and this is all debt is based in American dollars. So if their currency drops and American dollar goes up against the yuan, they're going to have to pay back in those more valuable American dollars, and then they're in trouble. So they're really in between the rock and a hard place.
It's a resource-dependent Australia that could pay the price.
Such a big trading partner for us. If the China demand does fall off on the back of a weaker economic condition, then the demand for our commodity will fall quite substantially.
The most recent figures from China suggest the economy is weakening, with factory activity slowing. But the official numbers might be underplaying how bad things really are.
I think the Chinese economy is struggling. The domestic economy is not growing, I believe, as fast as it's reported, in the high sort of 6%. And I make that statement on the basis that their property market is not doing very well.
Which gives China a greater incentive to get a deal on trade.
And I make that statement on the basis that their property market is not doing very well.
Which gives China a greater incentive to get a deal on trade.
They are the biggest trading nation in the world. So it's like ipso facto, they've got the most to lose. Self-interest tends to drive a lot of decision making.
It might not be a hard landing, but with Australia's fortunes tied to China, investors may have to buckle up.
Well, all right, that's a nice little conclusion to that China stock market and economy story. The next one is absolutely totally on the Australian housing at the moment. All right, and just the headline or the graphic there, Sydney slide, is kind of giving you an idea what the current status is. But let's hear it from the horse's mouth.
Sydney house prices are on the slide, recording the biggest annual price fall since the depths of the global financial crisis, and its Sydney suburbs showing some of the sharpest declines across the nation. While the country's largest market is feeling the winter chill, some of the best performers are regional centres like Geelong and Launceston. Good news for the Reserve Bank, who isn't tipped to touch the interest rate brakes until well into next year. Cameron Cusher is a senior research analyst for CoreLogic. He joined me from Brisbane. Cameron, housing prices have slipped for many Australian capital cities in the past quarter. Sydney leading it though. Why?
Well, I think it really comes back to the fact, at least, that we've seen really, really strong growth in Sydney over the last 6 or 7 years. Affordability stretched. We've also got credit tightening, particularly for investors. And investors have really been a major driving force of the Sydney housing market over that period of time. So all those factors combined have led to this weakness in the Sydney housing market, which has now been running since July of last year.
And we're seeing are we seeing a split between apartments and houses?
We're seeing a split in terms of the rate of decline for the apartment market is much more minor to date than it has been for houses. And I think that really comes back to the affordability story. When you're talking about a median above $1 million for a house in Sydney, a lot of people simply can't afford that. So even though units are expensive in Sydney relative to other capital cities, for a lot of people it's become the only option to get into the market.
Because we've had for many, many months, even possibly years, that we had this approaching apartment glut, that there was going to be ruination across that sector, particularly for investors. It hasn't happened. Do you think it will?
It hasn't happened to date, but I think with the apartment market, one of the interesting things we're finding now is a real weakness in rental growth. So over the last 12 months, rents in Sydney are only up by 0.1%. So the market is certainly slowing, and I think now the question becomes, what do investors do? They've seen a lot of capital growth. There's not a lot of capital growth in the immediate future. There's a lot more supply still coming online. So are those investors going to stick it out in the market, or are they going to look to exit the market? And I think that's probably the number one concern at this point in time.
Okay, so what will the investors do? So you've made nice little profit, almost no matter when you bought, minus the overheads and the interest and other things, expenses. But what do? You sell it, and whatever you profit after all the expenses, once again, you made, you're going to have to pay capital gains tax. And most people, unless they must sell, they think, oh, well, I'm just going to keep it because I just don't want to be paying those exit costs, including capital gains. So most people, in my opinion, will actually hold until they can't afford to hold anymore and they just have to offload. But that time, according to some, yours truly as well, is coming.
And is that the case for Brisbane and Melbourne as well?
Well, in Melbourne, you've got much stronger population growth than what you've got in Sydney or in Brisbane. So I think that to some degree is supporting the apartment market, both in terms of growth in values, but also in terms of the rental market. In Brisbane, we've been seeing apartment prices falling for a number of years. In fact, they're about 12% lower than they were a decade ago. So it's certainly depressed prices in Brisbane. The rental market, though, in Brisbane is slowly starting to recover. So it looks like the pullback in new apartment supply we've seen probably over the last 6 to 12 months is starting to flow through to the market.
Why is it that regionals are still seeing such strong growth? Some of them saw double-digit growth over the quarter.
Well, the regional markets are doing really strongly because affordability is pushing people away from the capital cities. Now, if we look at New South Wales, the surrounding areas to Sydney have been strong for the last 6 or 7 years, and they're actually now starting to slow down in line with the slowdown we're seeing in Sydney, talking about places like Illawarra, Newcastle and Lake Macquarie, and even the Southern Highlands and Shoalhaven. But if we look to Tasmania, we're seeing the growth from Hobart now filtering out to the southwest and to Launceston. And in Melbourne, we haven't seen a lot of that growth from Melbourne filter out into the regional markets really until the last probably 24 months. So Geelong is quite a strong market, and even areas like Bendigo and Ballarat, we're starting to see a bit of an acceleration in growth in those markets. And realistically, in Victoria, in areas like Geelong and Bendigo and Ballarat, if you're commuting on a train from those areas, it takes you just as long to get into the city as if you're commuting from a train down in the Mornington Peninsula or in Cranbourne or somewhere like that. So I think people are looking at that and saying, I can move technically out of Melbourne. I'm a similar distance from the outskirts of Melbourne, but my travel time is similar and the cost of housing is much lower.
So do you think that this trend is going to be long-lived or short-lived?
I think in terms of the regional markets, I think we'll see some strength there for a few years. It's probably not going to be quite as strong as it has been over the last couple of years, just because as you see a pullback in the major capital cities, it tends to flow out into those areas. But I think the lifestyle trend that we're seeing in some parts of the country will continue. Areas like the Sunshine Coast are doing quite well. Hobart's obviously a bit of a lifestyle play, and even Geelong, you've got the mix of the affordable stock in the city, but also the surf coast, where we are seeing quite a lot of demand in the market as well.
And in summary, over the past 5 years, property prices nationally are still up over 32%. So I guess we're all a long way from being ruined.
We certainly are, but I guess people have become very accustomed, particularly in Sydney and Melbourne, to prices increasing. And if you look 12 months ago, Sydney values were up 16.4%. They're down 4.5% over the last year. Similarly, Melbourne's only increased by 1% over the last 12 months compared to being up 13% 12 months ago. So it's very changed conditions. And with high levels of household debt, stretched affordability and tighter credit, there's probably not a lot of prospect for growth in the next couple of years. And with high levels of household debt, stretched affordability and tighter credit, there's probably not a lot of prospect for growth in the next couple of years.
Cameron Kushner, thank you so much for your time.
Thanks for having me.
Well, I'm not going to ruin it by doing any other different summary that he's just done. He was playing it safe throughout the interview. I think he's very knowledgeable, but he can only make his assessments and predictions as to what has happened maybe in the last 20-30 years or ever. If it's never crashed, he can't say it's going to crash, but I don't think it's too far away from it. And like I've stated before in my previous video, is that I don't think the housing needs to drop significantly at all. It just needs to stop growing to send the investors and everybody else running for the gates, not to mention the increased interest rates and tightening credit, i.e. not being able to actually borrow money. So with that, thank you very much, and I'll talk to you in the next video.